The collapse is not coming. It's already in motion. Most people won't see it until their portfolios are bleeding, their savings evaporating, and the headlines screaming what you should have known months ago. But there are signs, quiet signals, buried in the machinery of markets, visible only to those who understand where to look and what questions to ask. The question is not if the market will give up. The question is whether you'll recognize it before it's too late. Think about what a collapse actually means. It's not a singular event. It's not a day when everything crashes at once and alarms sound across trading floors. A collapse is a process, a deterioration that begins long before the first visible crack appears. It starts with leverage stretched too far, with valuations detached from fundamentals, with confidence built on assumptions that no longer hold. By the time most people notice, the structural damage is already done. The collapse isn't the moment prices fall, it's the moment the system loses its ability to stabilize itself. If you're serious about protecting what you built and positioning yourself for what's coming, subscribe now. The insights you'll get here are designed to help you see beyond the noise and understand the forces shaping the next phase of this cycle. Don't wait until the collapse is obvious to everyone. Join us and stay ahead. Now let's get into the mechanics of how you know when the market is about to give up. The first thing to understand is that markets don't collapse because of bad news. They collapse because of bad positioning combined with the wrong assumptions about liquidity, volatility, and time. When everyone believes the same thing, when portfolios are crowded into the same trades, and when leverage amplifies every move, the system becomes brittle. One shock, even a small one, can cascade into something far larger. That's not randomness, that's structure. One of the earliest warning signs is divergence. Not divergence in the sense of technical indicators on a chart, but divergence in the underlying behavior of markets versus the narratives being sold to you. When price action stops making sense relative to fundamentals, when volatility gets suppressed even as risks rise, when correlations break down in ways that suggest something is being held together artificially, that's when you need to pay attention. Divergence tells you that the market is no longer pricing reality, it's pricing hope, intervention, or denial. Consider what happens when central banks have been active for too long. When monetary policy has kept rates low, when liquidity has been pumped into the system repeatedly, and when financial conditions have been artificially eased to prevent downturns, the market begins to behave differently. It stops reacting to bad news the way it should. It shrugs off warning signs. It becomes complacent. Volatility, which should reflect uncertainty, gets compressed. Risk premiums, which should compensate for danger, shrink. That's not a sign of strength. That's a sign of fragility masked by intervention. This is where the concept of reflexivity comes into play. Markets are not just passive observers of reality. They shape reality. When prices rise, confidence grows. When confidence grows, people take more risk. When more risk is taken, prices rise further. The loop reinforces itself until something breaks. The break doesn't come from the loop itself. It comes from an external shock or an internal exhaustion where the system can no longer sustain the feedback. At that point, the reflexive loop reverses. Falling prices breed fear. Fear breeds selling. Selling drives prices lower. The descent accelerates, just as the ascent did, only faster and more violently. Another critical signal is the behavior of credit markets. Equity markets get the attention. They're visible, liquid, and emotional. But credit markets are where the real risks live. When credit spreads start to widen, when borrowing costs rise even as central banks try to keep them low, when high-yield bonds begin to underperform, these are not minor technical adjustments. They are the market telling you that default risk is rising, that confidence in the ability to service debt is eroding, and that the foundation beneath equity valuations is cracking. Credit doesn't lie the way equities can. It prices survival, not sentiment. You also need to watch the yield curve. When the yield curve inverts, when short-term rates rise above long-term rates, it signals that the market expects trouble ahead. Growth is expected to slow. Policy will have to ease. The cycle is turning. Historically, inversions have been reliable predictors of recessions, and recessions are often where markets give up. But here's the nuance. The inversion itself is not the collapse. It's the warning. The collapse comes later, often after the curve steepens again, as the market begins pricing in the damage that's already been done. Liquidity is another piece of the puzzle. Markets function because buyers and sellers can transact without moving prices dramatically. But when liquidity dries up, when bid-ask spreads widen, when volume thins, and when even small orders create large price moves, that's a sign that the market is losing its capacity to absorb stress. Illiquidity doesn't cause collapses, but it accelerates them. Once selling begins in an illiquid market, there's no cushion. Prices gap lower, stop losses trigger, forced liquidations cascade. What might have been a manageable decline becomes a rout. Now let's talk about positioning. One of the most dangerous setups is when everyone is positioned the same way. When hedge funds, pension funds, retail investors, and institutions are all long risk assets, all betting on the same outcome, the market becomes one-sided. There's no natural buyer left. When positioning is this crowded, any reason to sell, no matter how small, can trigger a stampede. The selling doesn't happen because fundamentals changed overnight. It happens because there's no one left to buy. That's a structural vulnerability, and it's one of the clearest signs that the market is fragile. Sentiment indicators are also worth watching. When bullish sentiment reaches extremes, when surveys show that almost everyone expects prices to rise, when put-call ratios are skewed heavily toward calls, and when fear gauges like the VIX are suppressed despite rising risks, that's complacency. Complacency is the opposite of vigilance. It's the moment when participants stop pricing in the possibility of loss. And that's exactly when losses tend to appear. Markets punish consensus. They punish comfort. They reward those who remain skeptical when everyone else is certain. Valuation alone won't tell you when the market will collapse, but it tells you how far it can fall. When price-to-earnings ratios are stretched, when equities are priced for perfection, when forward returns implied by current valuations are historically low, that there's no margin for error. High valuations don't cause crashes, but they set the stage for them. They mean that any disappointment, any shock, any recalibration of expectations will be met with violent repricing. The higher the starting point, the steeper the descent. Another layer to consider is the behavior of insiders and informed participants. When corporate insiders start selling their own stock in large quantities, when share buybacks slow or stop, when smart money begins rotating out of risk assets and into safer havens, these are actions that speak louder than words. Insiders have access to information that the public doesn't. They see the pipeline. They know the demand. They understand the pressures when they begin to de-risk. It's not because they're timing a short-term dip. It's because they see something systemic. Geopolitical and policy risks are also critical. Markets can absorb a lot of bad news when the structure beneath them is sound. But when debt levels are high, when monetary policy is already stretched, when fiscal space is limited, and when geopolitical tensions are rising, the system has less capacity to absorb shocks. A conflict, a policy mistake, a sudden tightening, a breakdown in trade. Any of these can be the spark that ignites the collapse. The vulnerability isn't the spark itself. It's the environment in which it occurs. Let's also examine the role of narratives. Markets are driven as much by stories as by numbers. When the dominant narrative is optimism, when everyone believes that central banks will always step in, that technology will always innovate, that growth will always return, those beliefs become priced in. But narratives are fragile. They shift quickly. When the narrative breaks, when confidence turns to doubt, when the story people tell themselves no longer matches the reality they see, the repricing is swift and brutal. Narrative collapses often precede price collapses. Remember that this content is educational and not financial advice, designed to help you think more clearly about the forces at work in markets and the decisions you face. Now let's talk about what you do with this information. Knowing the signs is one thing. Acting on them is another. The challenge is that these signals don't come with precise timing. You might see the warnings months before the collapse actually happens. During that time, the market can keep rising. Complacency can persist. Those who act early can look foolish, at least temporarily. But here's the truth. It's better to be early than late. It's better to reduce risk before the collapse than to scramble for exits when everyone else is running for the door. Positioning yourself ahead of a collapse doesn't mean going to cash entirely. It doesn't mean abandoning all risk. It means adjusting your portfolio so that you're not fully exposed to the reflexive unwind when it comes. It means holding assets that are not correlated with the crowded trades. It means owning things that have intrinsic value, that are not dependent on continued monetary easing, that are not priced for perfection. Gold and silver are examples of such assets. They don't rely on earnings growth. They don't depend on central bank intervention to hold value. They are stores of value that become more attractive as confidence in paper assets erodes. Hedging is another strategy. You don't have to predict the exact moment of collapse to benefit from hedging. Options puts inverse positions. These are tools that allow you to protect against downside while still participating in any remaining upside. The cost of hedging is often highest when it's least needed and lowest when it's most needed. That paradox is something most investors miss. They buy protection after the collapse has begun, when it's expensive and often too late. The smart approach is to hedge when hedges are cheap, when complacency is high, and when the consensus believes nothing can go wrong. Diversification also matters, but not the kind of diversification most people practice. Owning 100 different stocks doesn't protect you if they're all in the same market, all subject to the same forces, all dependent on the same assumptions. Real diversification means holding assets that behave differently under stress. It means owning things outside the traditional equity and bond framework. It means thinking globally, not just domestically. It means considering commodities, real assets, currencies, and alternatives that don't move in lockstep with the broader market. Liquidity is something else to think about. In a collapse, liquidity disappears. The assets you thought you could sell quickly become difficult to exit. Having some portion of your portfolio in truly liquid instruments, cash, short-term treasuries, assets that can be converted without loss, gives you optionality. It allows you to act rather than react. It means you're not forced to sell at the worst possible moment because you need access to capital. The psychological dimension is just as important as the technical one. Markets collapse because human behavior amplifies stress. Fear, panic, herd mentality, these are not irrational. They are rational responses to uncertainty and loss, but they are also predictable. When you understand that markets are driven by emotions as much as by fundamentals, you can position yourself to benefit from those emotional swings rather than become a victim of them. That means staying calm when others panic. It means being willing to act when others are paralyzed. It means having a plan before the collapse begins so that you're not making decisions in the heat of the moment. Another element to consider is the speed of collapses. They don't always happen gradually. Sometimes they happen in days or even hours. Flash crashes, liquidity crises, sudden deleveraging events. These can compress months of repricing into a single session. When that happens, there's no time to adjust. Your positions are locked in. Your losses are realized before you can react. That's why preparation matters. That's why understanding the signs ahead of time is not just useful, it's essential. Let's also talk about recovery. Collapses are not the end of markets. They are corrections, often violent, that reset valuations, clear out excesses, and create opportunities. The investors who survive collapses and thrive afterward are the ones who positioned themselves defensively beforehand and then had the courage and capital to act when assets were cheap. That's the full cycle. Protect during the collapse, deploy during the recovery. But you can't deploy if you've already lost everything in the collapse. That's why recognizing the signs early and acting on them is so critical. History provides plenty of examples. The dot-com bubble burst in 2000. The signs were visible months before. Valuations were absurd. Earnings didn't support prices. Liquidity was being withdrawn. Insiders were selling, yet most people held on, believing the narrative that the internet changed everything. When the collapse came, it wiped out trillions. The 2008 financial crisis followed a similar pattern. Credit spreads were widening. Housing data was deteriorating. Leverage was extreme. The yield curve had inverted. The warnings were there, but the consensus was that housing never goes down nationally, that risk was diversified, that the system was resilient. It wasn't. More recently, we saw a sharp drawdown in early 2020 when the pandemic hit. That was a shock, but the setup was already fragile. Valuations were high. Positioning was crowded. Complacency was extreme. The shock simply exposed the vulnerabilities that were already present. The recovery was swift, driven by unprecedented monetary and fiscal intervention. But that intervention didn't eliminate the risks. It deferred them. And now, years later, those risks are still there, compounded by even higher debt, even more stretched valuations, and even greater dependency on policy support. The current environment shows many of the same warning signs. Debt levels globally are at historic highs. Central banks have exhausted much of their traditional toolkit. Fiscal deficits are large and structural. Inflation has proven stickier than expected. Geopolitical tensions are rising. Credit spreads are starting to widen. Yield curves have inverted and are now steepening. Sentiment has been complacent despite these risks. Positioning is crowded into a narrow set of winners. Liquidity in many markets is thin. These are not isolated data points. They are part of a pattern that has preceded collapses in the past. What makes this moment particularly dangerous is the belief that intervention will always save the day. Markets have become conditioned to expect bailouts, rate cuts, liquidity injections, and stimulus whenever stress appears. That conditioning has created a moral hazard where risk-taking is rewarded and prudence is punished. But there are limits to intervention. Central banks cannot print productivity. Governments cannot borrow indefinitely without consequences. At some point, the interventions stop working. At some point, the market realizes that the tools are exhausted. That's when the collapse happens, not because of a specific event, but because the underlying structure can no longer be sustained. The final thing to understand is that collapses are not just about price. They are about confidence. Markets are built on trust. Trust that the system works, that promises will be kept, that debts will be repaid, that currencies will hold value. When that trust erodes, the collapse is not just financial, it's psychological. And psychological collapses are harder to repair than financial ones because they involve belief, perception, and sentiment. Once confidence is lost, it takes years to rebuild. So how do you know if the market is about to give up? You watch for divergence between price and reality. You monitor credit markets for signs of stress. You pay attention to the yield curve, to liquidity, to positioning, to sentiment. You listen to what insiders are doing, not what they're saying. You recognize when narratives are fragile and when complacency is extreme. You understand that collapses are processes, not events, and that the signs appear long before the headlines catch up. Most importantly, you act. You don't wait for confirmation because by the time the collapse is confirmed, it's too late. You position yourself defensively. You reduce exposure to crowded trades. You hold assets that preserve value in stress. You hedge when hedgers are cheap. You maintain liquidity so you have options. You stay calm when others panic. And you prepare not just to survive the collapse, but to thrive in what comes after. The market is not a static entity. It is a living system shaped by human behavior, policy decisions, and structural forces. It cycles through phases of expansion and contraction, confidence and fear, euphoria and despair. Right now, we are late in a cycle that has been artificially extended by intervention. The extension has created imbalances that will eventually need to be resolved. The resolution will not be gentle. It will be sharp, disruptive, and painful for those who are unprepared. But for those who see it coming, who understand the signs, who position themselves accordingly, the collapse is not a threat. It is an opportunity. It is the moment when assets reprice, when excesses are cleared, when the next cycle begins. The wealth that is destroyed during a collapse does not vanish. It transfers. It moves from those who are overconfident and overextended to those who are cautious and prepared. That transfer is how fortunes are made, not by predicting the future perfectly, but by positioning intelligently for the range of outcomes that are possible. The collapse is coming. The signs are already visible. The question is not whether the market will give up, but whether you will recognize it in time. Will you adjust your portfolio? Will you reduce your risk? Will you hold assets that preserve value? Or will you wait hoping that this time is different, that the warnings are false, that the system will hold together just a little longer? History suggests that hope is not a strategy, action is. The market rewards those who see what others miss and act on it before the crowd does. The collapse will shock most people because they are not paying attention, but it will not shock you. You have the knowledge, you have the framework, you have the tools. Now the question is whether you have the conviction to use them. The clock is ticking. The market is sending signals. The structure is fragile. The collapse is not coming. It is already in motion. The only question left is what you will do about it.